Lesson 7 to 9 Introduction to SPACs. Lesson 7 Risks and Challenges of SPAC Investing. Identify the potential risks and challenges associated with investing in SPACs. Investing in SPACs, special purpose acquisition companies, carries certain risks and challenges that investors should be aware of. While SPACs can provide opportunities for investors, it's important to consider the following potential risks. Uncertain investment outcome. SPAC investors face uncertainty regarding the specific target company that the SPAC will merge with or acquire. The investment outcome is contingent upon the success of the merger or acquisition, which introduces potential risks associated with the target company's financial performance. Market conditions and execution of the post-transaction business plan. Lack of track record. SPACs are typically newly formed entities with no operating history. As a result, there may be limited or no track record to evaluate the SPAC's management team's ability to identify and execute successful transactions. Investors may face challenges in assessing the expertise, experience, and track record of the SPAC's management team. Volatility and price fluctuations. SPAC shares can be subject to significant volatility and price fluctuations. Prior to a merger announcement, the share price may trade below or close to the IPO price, which can lead to potential losses for investors. Additionally, market sentiment, macroeconomic factors, and investor speculation can influence the share price of the SPAC, which may not necessarily reflect the underlying value of the target company. Redemption risk. Shareholders have the option to redeem their shares for a pro rata portion of the funds held in the trust account if they do not approve of the proposed merger or acquisition. This redemption option may lead to a significant number of shareholders redeeming their shares, potentially impacting the financial structure and ownership of the merged entity. It can also result in reduced available funds for the merged entity's operations and growth. Dilution and ownership impact. The completion of a merger or acquisition by a SPAC can result in dilution of existing shareholders' ownership stakes, especially if a significant number of shareholders choose to redeem their shares. This dilution may impact the value of the investment and the voting power of remaining shareholders. Regulatory and market risks. SPACs are subject to regulatory scrutiny and compliance requirements. Any failure to meet regulatory obligations, including the completion of a qualifying transaction within a specified timeframe, can have implications for the SPAC and its shareholders. Additionally, changes in market conditions, investor sentiment, or regulations governing SPACs can impact the investment climate and the ability to complete successful transactions. Target company risk. The success of a SPAC investment relies on the target company's future performance and prospects. Investors may face risks associated with the target company's financial health, competitive positioning, industry challenges, regulatory compliance, and execution of growth strategies. It is crucial to conduct thorough due diligence on the target company and assess its potential risks and opportunities. It's important for investors to carefully assess the risks and challenges associated with investing in SPACs and consider factors such as the reputation and experience of the SPAC's management team, the investment strategy, the quality of potential target companies, and the potential for value creation. Diversification, thorough research, and consultation with financial advisors are key in managing these risks and making informed investment decisions. Discuss the uncertainties surrounding the selection of a target company and the performance of the merged entity. The selection of a target company and the subsequent performance of the merged entity in a SPAC, special purpose acquisition company, transaction involve inherent uncertainties. Here's a discussion of the uncertainties surrounding these aspects. Target company selection. Market conditions. The selection of a target company is influenced by market conditions, which can be unpredictable. Economic factors, industry trends, and competitive dynamics can impact the availability and attractiveness of potential target companies. Fluctuations in market conditions can create uncertainties and affect the number and quality of available targets. B. Timing. The timing of identifying and completing a transaction is uncertain. It depends on various factors, including the availability of suitable target companies, negotiation timelines, regulatory approvals, and market conditions. The process can take longer than anticipated, which introduces uncertainties and potential delays. C. Deal structure. The structure of the deal, including the consideration, transaction terms, and post-merger integration, is subject to negotiation and agreement between the SPAC and the target company. Finding alignment on these terms can be challenging and may involve trade-offs and uncertainties regarding valuation, financing arrangements, and ownership structure. Performance of the merged entity. A. Execution risk. The post-merger execution and integration of the target company into the SPAC can present challenges. Successfully merging operations, systems, cultures, and resources requires effective planning, management, and coordination. The ability to execute the identified synergies and achieve projected financial and operational targets may be uncertain. B. Market and competitive factors. The performance of the merged entity can be influenced by market dynamics, industry trends, and competitive forces. The target company's competitive positioning, market demand for its products or services, and industry-specific challenges can impact its performance and the overall success of the combined entity. External factors beyond the control of the merged entity may introduce uncertainties. C. Financial performance. The financial performance of the merged entity is subject to various factors, including revenue growth, profitability, cash flow, and debt levels. Changes in market conditions, customer behavior, regulatory landscape, or macroeconomic factors can affect financial performance. Projections made during the due diligence process may not materialize as expected, leading to uncertainties regarding financial outcomes. D. Integration challenges. Integrating different corporate cultures, processes, and systems can be complex and present challenges. Misalignment, resistance to change, and communication gaps may arise, impacting the integration process and the performance of the merged entity. The ability to realize synergies, maintain employee morale, and retain key talent may be uncertain. E. Regulatory and legal considerations. Compliance with regulatory requirements, including obtaining necessary approvals and licenses, is crucial for the merged entity's operations. Regulatory changes, legal disputes, or non-compliance issues can introduce uncertainties and impact the performance of the combined entity. It's important for investors and stakeholders to acknowledge and evaluate these uncertainties when considering SPAC investments. Thorough due diligence, careful assessment of potential risks and opportunities, and consideration of alternative scenarios are essential. Engaging with experienced professionals, including financial advisors and legal counsel, can help navigate the uncertainties and make informed investment decisions. Evaluate the liquidity, regulatory, and governance risks that investors should consider before investing in a SPAC. Before investing in a SPAC, special purpose acquisition company, investors should carefully evaluate several risks related to liquidity, regulatory compliance, and governance. Here's an evaluation of these risks. Liquidity risks. Limited liquidity. SPAC shares may have limited liquidity, especially during the period before a merger or acquisition is announced. Investors may find it challenging to buy or sell shares at desired prices due to lower trading volumes or lack of market interest. This illiquidity can restrict investors' ability to exit their positions or realize their investments when desired. B. Lockup periods. SPAC shares may be subject to lockup periods that prevent investors, including institutional investors and insiders, from selling their shares for a specified period after the completion of a merger or acquisition. This lockup period can further limit liquidity and restrict investors from freely trading their shares. Regulatory risks. Compliance and regulatory changes. SPACs are subject to regulatory requirements, including securities laws and regulations governing public offerings and mergers. Failure to comply with these regulations can result in penalties, legal disputes, or reputational damage. Additionally, regulatory changes or increased scrutiny of SPACs can impact their operations, funding mechanisms, or ability to complete transactions. B. Securities and Exchange Commission, SEC, scrutiny. The SEC regulates SPACs and monitors their activities to ensure compliance with securities laws. Regulatory scrutiny and enforcement actions can introduce uncertainties and impact the operations and value of the SPAC. Investors should consider the potential implications of SEC scrutiny on their investments. Governance risks. A. Management team expertise. The success of a SPAC investment depends on the expertise and track record of the management team responsible for identifying and executing a merger or acquisition. Investors should assess the team's experience, industry knowledge, and ability to deliver value to shareholders. Lack of experienced management can increase execution risks and reduce the likelihood of a successful transaction. B. Conflicts of interest. conflicts of interest may arise between the SPAC's management team and shareholders. For example, the management team may have personal interests that differ from those of the investors, such as seeking a transaction that maximizes their own financial gain rather than delivering the best outcome for shareholders. Investors should carefully evaluate the governance structure and ensure appropriate checks and balances are in place. See shareholder rights and protections. Investors should assess the rights and protections afforded to shareholders, including voting rights, redemption rights, and information rights. The absence of robust shareholder protections or a governance framework that does not adequately represent the interests of shareholders can increase governance risks and diminish investor confidence. Financial risks. A. Investment outcome uncertainty. The investment outcome of a SPAC depends on the success of the merger or acquisition transaction. Uncertainty surrounding the financial performance, market conditions, and execution of the post-transaction business plan can introduce financial risks. Investors should carefully evaluate the target company, conduct due diligence, and assess the potential risks and rewards of the investment. B. Capital structure and dilution. The capital structure of the merged entity and potential dilution of shareholders' ownership stakes should be considered. The amount of debt, equity, and potential dilutive effects resulting from the transaction can impact the financial position and value of investors' holdings. It's crucial for investors to thoroughly evaluate these liquidity, regulatory, and governance risks before investing in a SPAC. Conducting due diligence. Seeking advice from financial professionals, and carefully reviewing the SPAC's offering documents and regulatory filings can help investors make informed decisions and manage these risks effectively. Lesson 8. SPACs in the global investment landscape. Explore the global landscape of SPACs and understand their prevalence in different jurisdictions. The global landscape of SPACs, special purpose acquisition companies, has seen significant growth and evolving dynamics in recent years. While the concept of SPACs originated in the United States, they have gained popularity and traction in various jurisdictions worldwide. Here's an overview of the prevalence of SPACs in different jurisdictions. United States. The United States has historically been the dominant market for SPACs. SPACs gained popularity in the early 2000s, and their usage has surged in recent years. U.S. exchanges, such as the New York Stock Exchange, NYSE, and NASDAQ, have been major listing venues for SPACs. The U.S. Securities and Exchange Commission, SEC, provides regulatory oversight, and U.S. SPACs are subject to specific regulations, including the Securities Act of 1933 and the Securities Exchange Act of 1934. Europe. SPACs have gained traction in Europe, with several jurisdictions witnessing increased interest and regulatory developments. For example, the United Kingdom has seen a surge in SPAC activity, primarily driven by the London Stock Exchange, LSE, and Alternative Investment Market, AIM. Other European countries, including Germany, the Netherlands, France, and Luxembourg, have also seen the emergence of SPACs and regulatory initiatives to accommodate such structures. Asia-Pacific. The Asia-Pacific region has experienced growing interest in SPACs, although the prevalence varies across jurisdictions. In recent years, jurisdictions such as Singapore and Hong Kong have seen regulatory developments to enable SPAC listings. Other countries, including Australia and South Korea, have also witnessed increased activity in the SPAC space. Canada. Canada has emerged as a significant market for SPACs. Canadian exchanges, such as the Toronto Stock Exchange, TSX, and the TSX Venture Exchange, have been popular listing venues for SPACs. The regulatory framework in Canada has accommodated SPAC structures, and several successful transactions have taken place. Other jurisdictions. SPACs have also gained attention and traction in other jurisdictions, including Latin America, the Middle East, and certain African countries. Regulatory frameworks and market dynamics vary across these jurisdictions, and the prevalence of SPACs may be influenced by local regulations, investor appetite, and market conditions. It's worth noting that regulatory frameworks and requirements surrounding SPACs can differ significantly across jurisdictions. Local securities regulators play a crucial role in overseeing SPAC activities and ensuring compliance with applicable laws and regulations. As the global landscape of SPACs continues to evolve, jurisdictions are actively considering regulatory reforms and amendments to accommodate these structures while maintaining investor protection and market integrity. investors and market participants interested in SPACs should closely monitor regulatory developments, seek expert advice, and consider the jurisdiction-specific dynamics and risks associated with SPAC investments. Compare and contrast the regulatory frameworks and investor protections in various countries. Regulatory frameworks and investor protections for SPACs, special purpose acquisition companies, can vary significantly across different countries. Here's a comparison of the regulatory frameworks and investor protections in several jurisdictions. United States, regulatory framework. SPACs in the United States are subject to the oversight of the U.S. Securities and Exchange Commission, SEC. The SEC regulates public offerings, securities transactions, and disclosure requirements. Investor protections. U.S. SPACs are subject to specific regulations, including the Securities Act of 1933 and the Securities Exchange Act of 1934. These regulations provide investor protections through disclosure requirements, restrictions on insider trading, anti-fraud provisions, and rules governing public offerings. United Kingdom, regulatory framework. The regulatory framework for SPACs in the United Kingdom is overseen by the Financial Conduct Authority, FCA. The FCA regulates the listing and trading of securities on the London Stock Exchange, LSE, and alternative investment market, IM. Investor protections. The FCA imposes regulatory requirements on SPACs to ensure investor protections. These requirements include disclosure obligations, transparency rules, and compliance with the UK Corporate Governance Code. Shareholder rights and protections are also provided under company law. Canada, regulatory framework. SPACs in Canada are regulated by the Canadian securities regulators, including the Ontario Securities Commission, OSC. Listing and trading of SPACs occur on the Toronto Stock Exchange, TSX, and the TSX Venture Exchange. Investor protections. Canadian securities regulators enforce regulations to protect investors. These protections include disclosure requirements, fair dealing obligations, restrictions on insider trading, and regulations governing public offerings. Singapore, regulatory framework. The regulatory framework for SPACs in Singapore is overseen by the Monetary Authority of Singapore, MAS, and the Singapore Exchange, SGX. The SGX provides listing rules, while the MAS ensures compliance with securities regulations. Investor protections. Singapore has regulations and investor protections in place to safeguard investor interests. These include disclosure requirements, regulations against market manipulation and insider trading, and regulations governing public offerings. Australia. Regulatory framework. SPACs in Australia are regulated by the Australian Securities and Investments Commission, ASIC. The listing and trading of SPACs occur on the Australian Securities Exchange, ASX. Investor protections. The ASIC enforces regulations to protect investors. These regulations include disclosure requirements, market integrity rules, and regulations governing public offerings. It's important to note that the regulatory frameworks and investor protections can evolve over time, and specific regulations may vary within each jurisdiction. Investors should stay updated on regulatory developments, consult with legal and financial professionals, and carefully review the applicable laws and regulations to understand the specific investor protections in each jurisdiction. Additionally, it's worth noting that investor protections can extend beyond the SPAC regulatory framework to encompass broader securities regulations, corporate governance standards, and legal frameworks that apply to all companies listed on stock exchanges within a particular jurisdiction. Discuss the impact of cross-border mergers and acquisitions on the SPAC market. Cross-border mergers and acquisitions, M&A, can have a significant impact on the SPAC, special purpose acquisition company, market. Here's a discussion of the key implications. Global expansion opportunities. Cross-border M&A transactions provide SPACs with opportunities to acquire target companies in foreign markets. This allows SPACs to expand their operations, access new markets, and tap into the growth potential of different regions. Cross-border transactions enable SPACs to diversify their portfolios and gain exposure to international markets, industries, and customer bases. Access to high-growth sectors. Cross-border M&A allows SPACs to target companies operating in high-growth sectors that may be more prevalent in certain jurisdictions. By acquiring companies with expertise, technologies, or market presence in these sectors, SPACs can position themselves as leaders in emerging industries such as renewable energy, technology, healthcare, or e-commerce, enhanced investor interest. Cross-border M&A transactions can attract increased investor interest in SPACs. Investors may be attracted to SPACs that pursue cross-border deals as it provides exposure to global markets and potential access to innovative and promising companies that are not available within their domestic markets. This expanded investment opportunity can lead to increased demand for SPAC shares and potentially drive share prices higher. Regulatory and compliance considerations. Cross-border M&A transactions involve navigating different regulatory frameworks and compliance requirements in multiple jurisdictions. SPACs pursuing cross-border deals must carefully assess the regulatory environment, legal complexities, and potential cultural and business differences. Compliance with local laws. Obtaining necessary approvals and addressing cross-border legal and tax considerations become crucial factors in executing successful cross-border transactions. Currency and exchange rate risks. Cross-border M&A involves transactions denominated in different currencies. Fluctuations in exchange rates between the currencies of the SPAC and the target company can impact the value of the transaction. Currency risk management and hedging strategies may be necessary to mitigate the impact of exchange rate fluctuations and ensure a favorable deal outcome. Geopolitical and economic factors. Cross-border M&A can be influenced by geopolitical factors, economic stability, and market conditions in different jurisdictions. Changes in political landscapes, trade policies, regulatory regimes, or economic downturns can introduce uncertainties and affect the timing and success of cross-border transactions. SPACs must carefully assess the risks associated with geopolitical and economic factors to make informed investment decisions. Integration and cultural considerations. Cross-border mergers involve integrating companies with potentially different cultures, management styles, and business practices. The success of post-merger integration hinges on effectively managing these differences, fostering collaboration, and aligning strategies. Cultural understanding, communication, and integration planning are crucial to ensuring a smooth transition and maximizing the potential benefits of the cross-border transaction. Overall, cross-border mergers and acquisitions offer SPACs the opportunity to access new markets, sectors, and growth potential. However, they also present challenges in terms of regulatory compliance, cultural integration, and managing geopolitical and economic risks. Successful execution of cross-border transactions requires careful due diligence, expert advice, and effective risk management strategies. Lesson 9. SPACs and the Future of Finance. Analyze the evolving role of SPACs in the financial industry and their impact on traditional IPOs and investment strategies. SPACs, special purpose acquisition companies, have experienced a significant evolution in their role within the financial industry, leading to notable impacts on traditional IPOs and investment strategies. Here's an analysis of these evolving dynamics. Alternative path to going public. SPACs have emerged as an alternative path for companies to go public, offering an alternative to traditional initial public offerings, IPOs. SPACs provide a faster and potentially more streamlined process for companies to access public markets. This has led to increased interest from private companies considering going public, as SPACs offer a more flexible and efficient route. Increased deal activity. The rise of SPACs has led to a surge in deal activity, with numerous SPACs actively seeking merger or acquisition targets. This has resulted in a larger pool of potential targets for companies considering going public or seeking capital injections. SPACs provide an avenue for private companies to enter public markets without undergoing the traditional IPO process, thus increasing the deal-making opportunities. Disruption of traditional IPO market. The popularity of SPACs has disrupted the traditional IPO market. SPACs can offer companies more control over the valuation and timing of their public listing. Additionally, SPACs provide an opportunity for companies to access capital markets during periods of uncertainty or market volatility when traditional IPOs may be less attractive. This has forced traditional IPO underwriters to adapt their practices to compete with the appeal of SPACs. Shifting investment strategies. The rise of SPACs has prompted investors to adjust their investment strategies. Investors have been attracted to SPACs for their potential high-growth opportunities and access to innovative companies. This has led to an increase in funds allocated specifically for SPAC investments and the emergence of specialized SPAC-focused investment firms. Investors have had to adapt their strategies to include evaluating SPACs as potential investment vehicles. Market volatility and risk. the growing prevalence of SPACs has introduced additional market volatility and risk factors. As more SPACs enter the market, investors need to carefully assess the quality and track record of the SPAC management teams and the potential target companies. There is a risk that some SPACs may not successfully identify suitable targets or execute value-generating transactions, which could impact investor returns. Regulatory scrutiny and reforms. The rapid growth of SPACs has drawn regulatory attention. Authorities, such as the U.S. Securities and Exchange Commission, SEC, have increased scrutiny of SPACs, focusing on disclosure practices, conflicts of interest, and investor protection. This has led to potential regulatory reforms and stricter regulations to enhance transparency and ensure investor safeguards. Market maturation and consolidation. As the SPAC market continues to evolve, it is experiencing a phase of maturation and consolidation. Market participants are learning from past experiences, and the quality and standards of SPACs are expected to improve. The market may see a higher bar for SPAC sponsor qualifications, increased scrutiny of target companies, and enhanced governance practices. It's important to note that the dynamics of SPACs and their impact on traditional IPOs and investment strategies are still evolving. The long-term implications will depend on factors such as regulatory developments, market conditions, and investor sentiment. Investors and market participants need to carefully evaluate the risks and opportunities associated with SPAC investments and adapt their strategies accordingly. Discuss the potential future developments and regulatory changes in the SPAC market. The SPAC, Special Purpose Acquisition Company, market is subject to ongoing regulatory scrutiny and potential future developments. Here's a discussion of potential future developments and regulatory changes in the SPAC market. Enhanced regulatory oversight. Regulatory bodies, such as the U.S. Securities and Exchange Commission, SEC, and other global regulators, may implement stricter regulations and enhanced oversight to address concerns regarding investor protection, transparency, and disclosure practices. These regulatory changes could involve more rigorous requirements for SPACs related to target identification, valuation, and post-merger performance. Disclosure and reporting requirements. Regulators may impose additional disclosure and reporting requirements on SPACs to ensure adequate transparency for investors. This could include more detailed information on the target company evaluation process, conflicts of interest, financial projections, and risks associated with the proposed transaction. Corporate governance reforms. Regulatory changes may focus on enhancing corporate governance practices within SPACs. This could involve imposing stricter standards for SPAC sponsor qualifications, independence requirements for board members, and increased scrutiny of director responsibilities and fiduciary duties. Investor protection measures. Regulators may implement measures to enhance investor protection in the SPAC market. This could include strengthening redemption rights, improving the clarity of investor disclosures, and addressing potential conflicts of interest among SPAC sponsors, underwriters, and shareholders. SPAC to SPAC process standardization. Regulatory bodies and market participants may work toward standardizing the de-SPAC, merger or acquisition, process to ensure consistent practices and improve transparency. This could involve establishing guidelines for target company selection, valuation methodologies, and shareholder approval processes. Market consolidation and increased quality standards. As the SPAC market matures, there may be increased consolidation and a focus on quality standards. Market participants may favor SPACs with experienced management teams, strong track records, and robust due diligence processes. This could result in a more selective approach to SPAC investments and increased competition among SPACs to attract investors and quality target companies. International harmonization. Regulators across jurisdictions may collaborate to harmonize regulations and standards related to SPACs. This would facilitate cross-border transactions, streamline regulatory requirements, and enhance investor confidence in the global SPAC market. Continued investor education and due diligence. Investor education and awareness regarding the risks and benefits of investing in SPACs will likely continue to evolve. Investors are encouraged to conduct thorough due diligence, seek professional advice, and understand the specific risks associated with SPAC investments. It's important to note that the specific nature and timing of regulatory changes and market developments in the SPAC market remain uncertain. Regulatory reforms are influenced by a variety of factors, including market conditions, investor feedback, and the potential impact on capital formation. Investors and market participants should closely monitor regulatory developments and adapt their strategies accordingly to navigate potential changes in the SPAC landscape. Consider the long-term implications and challenges of SPAC investing. SPAC, Special Purpose Acquisition Company. Investing comes with long-term implications and challenges that investors should consider. Here are some key considerations. Investment performance. The long-term performance of SPAC investments can vary significantly. While some SPACs have been successful in identifying and merging with high-growth companies, others have faced challenges and underperformed. Investors need to carefully assess the track record, expertise, and due diligence capabilities of the SPAC management team to evaluate the potential for long-term value creation. Market volatility and timing. SPAC investments can be influenced by market volatility and timing. The overall market conditions, economic factors, and investor sentiment can impact the performance of SPACs. Investors should be prepared for potential fluctuations in share prices, as well as uncertainties regarding the timing of target company identification, merger completion, and subsequent market performance. Risk of capital loss. Investing in SPACs carries the risk of capital loss. If a SPAC fails to identify a suitable target or complete a merger/acquisition within the specified timeframe, shareholders may face a loss of their invested capital. Additionally, the performance of the merged entity post-transaction may not meet expectations, leading to a decline in the value of the investment. Dilution and ownership impact. Investors should consider the potential dilution of their ownership stakes due to share redemptions or additional fundraising in the post-merger entity. Dilution can impact the value and ownership rights of existing shareholders and should be carefully evaluated as part of the investment decision-making process. Regulatory and compliance risks. The SPAC market is subject to regulatory scrutiny and potential regulatory changes. Regulatory compliance requirements, including disclosure obligations, reporting standards, and shareholder protections, can impact the operation and performance of SPACs. Investors should stay informed about regulatory developments and assess the potential impact on their investments. Liquidity and exit strategy. SPAC investments may pose challenges in terms of liquidity and exit strategies. While shareholders typically have the option to redeem their shares, the ability to sell shares in the secondary market may be limited, especially before the completion of a merger or acquisition. Investors should be prepared for potential illiquidity and assess their investment horizon and liquidity needs accordingly. Selection and due diligence. Proper due diligence is crucial when selecting SPACs for investment. Investors should thoroughly assess the SPAC's management team, investment strategy, track record, target company evaluation process, and alignment of interests between the management team and shareholders. Conducting thorough research, reviewing offering documents, and seeking professional advice can help mitigate potential risks. Evolving market dynamics. The SPAC market is dynamic and subject to evolving trends, regulatory changes, and market conditions. Investors need to stay informed about market developments, competition among SPACs, changes in investor sentiment, and potential shifts in regulatory frameworks. Adapting investment strategies to changing market dynamics is essential for long-term success. It's crucial for investors to evaluate the long-term implications and challenges of SPAC investing and carefully assess the potential risks and rewards. Conducting thorough research, diversifying investment portfolios, and seeking professional advice can help navigate the challenges and make informed investment